Like most of the larger companies, as you know, pay very little in tax. They don't just have a CPA.
Right.
They have multiple CPAs and they probably have multiple attorneys, a lot of them tax attorneys and business strategists, and they utilize all those resources to reduce the tax liability of the corporation, which is really important for the shareholders.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Mark Myers. Mark, how are you doing today?
I'm doing great, Todd. Thank you so much. How are you?
Excellent. And a little bit about Mark. He is the founder and CEO of TaxWise Partners, spent more than a decade helping thousands of clients slash their tax bills by an average of 50% without replacing their CPAs or financial advisors. That's pretty cool. I think most people would like to pay less in taxes. So I definitely want to dive into that. Why don't you give our listeners a bit more about your background, what TaxWise Partners does, and then we'll dive in with some questions.
Absolutely, Todd. I'd love to do that. If you think about backgrounds, it's pretty interesting. Most people say, "Oh, how did you get involved in this layer of tax planning?" And I say, "Well, it's an interesting story because I went to the University of Florida and got my bachelor's degree in exercise physiology, got my master's degree in sports management. I ran high-end health clubs in New York City and Los Angeles for over a decade. So people are like, well, how in the world are you
Yeah,
in the
right.
tax planning space?" And I say, well, when I worked for another company, my focus in running those companies was driving revenue, managing expenses. The better our EBITDA margins were, the more I got paid. And I realized over time, like I would never make more than $250,000 a year running somebody else's business, even though I'm helping them with the margins and pushing, maybe multiple seven figures of EBITDA profit out of each store. So I said, let me switch gears here. I understand how to run a business. I can speak the language of a business owner. Let me actually be a consultant to business owners. So I switched gears and went into insurance. Now I did more sophisticated insurance planning, buy, sell, key man, all that good stuff. But what I realized when I was in the insurance space is that tax efficiency is a large component of insurance. And then once you start going down that rabbit hole, you realize, wait a minute, there's a lot more to tax efficiency than just life insurance.
Yeah.
And that's what started my evolution to saying, wow, there's a lot of tax code, thousands and thousands and thousands of pages. And there's a lot of coupons in that tax code, right? You just have to know where to look and how to apply those coupons. So that's basically about 10 years ago. That's what I shifted my business and said, let me help people find the coupons because everyone pays retail, but they should be paying wholesale. Like nobody goes to the store and wants to pay ticket price. They want to pay wholesale. Nothing's different in taxes. It's no difference. You just have to know where to find the coupons. And, I took the business, Todd, to CPAs and enrolled agents and RIAs. I've never really tried to go get to the high income earner directly because there's a significant gap in trust, particularly with taxes. So if I build rapport and the RIAs that already have a fiduciary responsibility or the CPAs or and EAs that are already, very conservative by nature, once they understand what we do and they're comfortable, it's so much easier for us to help clients because they introduce us to their highest income earning clients and we solve the problems that they don't have time to solve.
Hmm.
So it's been a fun journey. I'd say it's you know, part of wealth building is not just increasing your revenue and making good investments, but reducing your biggest expenses.
Yeah, and taxes are certainly the, probably the biggest for most people, or one of the bigger ones, definitely. Um, and it's easy. I feel like it's a lot easier to maybe not easier, probably a lot wiser to control your expenses and not have to always be focused on only growing the company and selling more, but then having expenses that are out of control. You see it so often where companies struggle because they can't keep their expenses under control. They just keep on spending it more and more and more and more. And if you ever have a time where the revenue somehow dips or there's a, like a COVID type thing, man, I mean, you're maybe a few months away from not being in business anymore.
That's absolutely true. And a lot of people don't look at the tax line as a profit center. And if your tax liability is pushing into the federal 32, 35, and 37% bracket, and of course, say you live in California, New York, or any state other than Washington, Florida, Texas, Wyoming, you're going to have a pretty high profit center. Like if you can reduce your 37% and 35 and 32% bracket, and of course, if you also have state income tax on top of it, if you can start shaving those percentages down, that's a significant increase in profit without having to sell $1 more of product. So that's really the focal point that we try to hammer home with our clients is, be wiser with that profit center because again, what do you mean tax? My tax liability is a profit center? Yes, because you're probably overpaying.
Yeah, yeah. Hey, you show here that over 90% of high income earners unknowingly overpay their taxes, even if they've got guidance of top CPAs. So, like, what are the most common ways? Like, why are people overpaying? Why, especially you hire a good CPA, you expect them to be able to catch those types of things. Like, why are people overpaying?
Yeah, that I would say just to benefit the CPAs that may listen to this, and of course, all the CPAs that I work with that are strategic partners, they're phenomenal at what they do. But they're phenomenal in the accounting process. They're phenomenal in the tracking recording process. They're phenomenal in understanding how to prep and file the returns. But they don't generally have the desire or the bandwidth to go outside of that realm and say, well, what if my client were to start a business and that business produced a significant amount of depreciation, possibly even tax credit or itemized deductions? That's an outside of the box world that they just don't have time and bandwidth to do. And that's when I come in and say, well, tax savings isn't just line item accounting. It's also what additional opportunities can you create that are outside of the box but completely legal, completely towards the code. It's just the things you wouldn't think about unless you're
Hmm.
going outside of the box. So that's
Yeah.
really where I think the benefit becomes to expand your professional network. And I always like to use the analogy of, the bigger your business and the more profit you have, the more resources you need. Like most of the larger companies, as you know, pay very, very little in tax. They don't just have a CPA.
Right.
They have multiple CPAs and they probably have multiple attorneys, a lot of them tax attorneys and business strategists, and they utilize all those resources to reduce the tax liability of the corporation, which is really important for the shareholders. Shareholders want results. So we're just kind of creating that additional bandwidth for, smaller, medium-sized companies or just very successful solopreneurs.
Give me a concrete example. Of course, you don't have to share any names, or you can give just a scenario, but give me a concrete example of exactly what that could look like. The small business owner, which is, most of the people listening to this are, small business owners, solopreneurs, real estate investors, those types of people. Give me an example, concrete example. What have you seen somebody do that has saved them a significant amount of money on their tax return?
I'll give you an example of a recent client, um, very successful HVAC business owner in one of the, worst states to be in with regard to tax liability, California.
Yeah, I was gonna say he's either in California or Minnesota. I'm in Minnesota, so yeah.
New York is pretty nasty
Yeah.
too, and there's a few. You believe it or not, Idaho and some of those states are higher than you'd expect. But
Wow. Okay.
but California, you're not going to get worse than California with you get because you have the 14.3%
Yeah.
state tax on top of your 37% federal at the top bracket. So literally 50% of your profit could be going to the government. And of course, they're not a business partner. Like generally, if you're going to give 50% of your profit to someone, so you're being a business partner.
Yeah. Yeah.
Um, so this gentleman was very successful in his HVAC business. Had a lot of ordinary income that spun off from it. You know, paid himself a decent salary, but had a lot of profit above his salary on an annual basis. And he also wanted to sell his business, which gave us a kind of a twofold opportunity. So what first thing we did was attack his ordinary income. We said we kept it real simple for him. There's a lot of things that can be done because he was about to sell his business. We said let's just do a couple of simple things. One was, why don't you become a solar business owner? And he was like, why would I want to do that? And I said, well, because if you originate solar projects in an LLC that we can turnkey for you, just like when you buy a duplex in an LLC or whatever, you know, real estate, you're not only going to get cash flow, just like you get when you buy real estate, you know, rental income real estate, you're going to get cash flow from the energy that that solar project produces. But you're also going to get depreciation, and you're going to get a lot of it in a very short period of time, right? All of the real estate moguls out there understand cost segregation. You have to pay an engineering study to accelerate your depreciation. Whereas with solar, it's only 5.5 years to begin with. And then you can take a boatload of it on the front end as bonus depreciation because the federal government's still offering bonus depreciation. So now you can buy solar, get cash flow, depreciation over a very short period of time, a lot of it in the first year. And guess what else the federal government gives you? Tax credit. The best, I mean, I love depreciation, I love itemized deductions, but when you can get $1 of tax credit, that's depreciation and deductions because $1 of tax credit offsets $1 of federal tax. $1 of depreciation just reduces your income by $1.
Hmm.
So you can see the power of tax credit.
Yeah.
So when I said to him, with every dollar that you redirect into your solar business, right? Because he's in a 50% tax bracket in California. Literally every dollar that he redirects into his solar business, he's going to reduce his taxes by 50 cents. So he can literally put $1 in his solar business and save $1.50 in tax.
That's amazing.
So that was the one thing that we did for him. And we made it super easy. He's like, I don't really have a lot of time to run an extra business. I said, well, we can make it super easy for you, or we can have your spouse do it. Doesn't matter. Your spouse does it. Still, if you're married filing jointly, all those benefits flow into your 1040. Second thing we did was we said, you should be charitable. And he's like, wait a minute, I get to my church all the time. Last time I checked, I gave him $1. I saved 50 cents. It still cost me 50 cents. I'm like, you're right. It's great because you wanted to give your church $1. They got a whole dollar to spend on their philanthropic purposes. And it only cost you 50 cents to give them $1. That's not profitable. But you don't have to give a charity $1. You give charity an asset. He's like, well, how does that change anything? Well, what if you bought the asset for $1 and it's worth $4 or $5? That's the current appraised value. Well, you get to take the appraised value for your charitable donation if you follow the rules. So just those two things alone, we reduced his taxes by 70%. And the fun part of the equation was he had an offer for $8 million to buy his property, buy his business. He took it. And we significantly reduced his capital gains on the sale because we structured the sale prior to, so he didn't take constructive receipt of the income. He didn't have assignment of income, and the structure that received the payout, we zeroed out the tax, and now he has an opportunity to reinvest all of the money less the structure fees and grow that money and then kind of fit the tax burden over time. So kind of a nice little deferral strategy that we can also reduce on the excerpt. So those three things, solar business owner, charitable but resourceful charitable, plan your sale before you actually sign a purchase agreement or a binding letter of intent. And we can kind of make those tax bills almost disappear.
Yeah, that's a great deal. He did have to obviously be okay with starting a second business, but Man, that sounds what a great deal. Sounds like a definitely a win for a small investment there. Um, what a lot of people feel like maybe they end up doing this too late. Like when should you start? When is too late too late? I guess, and when should you start thinking about it? Think about how look, I'm paying way too much in taxes. Like, when's it too late, and when should you start?
So too late, there's a two-layer question. One would be if we're talking on like December 27th of the year, and you're like, man, I crushed it this year. What can I do?
Yeah.
That's going to be a tough one, right? Because,
Mm,
generally speaking, you need to create the efficiency in the year that you created the income.
right.
Um, so that's a little bit more challenging. Always the earlier in the year, the better. But there are things that can be done in the last hour of the year. So it's almost never too late, but you're just missing opportunity if you're starting this conversation in December because you've had a very strong year and you're like, what am I going to do? I'm tired of paying high taxes.
Yep.
But the second answer to that question, Todd, would be um, with certain tax credits, solar being one, and I'm a huge solar advocate so long as the laws stay the way they are, and we hope they do, even with the big, wonderful bill that's coming out. Um, any excess tax credit that you acquire via origination of solar through your turnkey solar business not only can be carried forward if you can't use it in the same calendar year, it can be carried backwards.
Hmm.
So when somebody says too late, I'm saying, yeah, well, maybe we are a little late to save a lot of taxes this year in 2025 because it's December 15th. You can only save so much. We could have saved more if we started in, February or March or April of 2025. But why don't we focus on your solar business in 2026? Get you some extra tax credits at a significant discount, right? If you can buy a $1 tax credit for 50 cents, how many will you buy if you can get refunds for 2024 or 2023 or even 2022? We can go back 3 years.
Oh wow.
So what I'm doing now with clients is saying, hey, this is how much to offset your 2025 tax. But if you want to buy an extra 100 grand of tax credit, you can get it for 50 grand. And then you can go get a refund for 2022 so now you got a 100 grand refund, only cost you 50 grand.
So if I got $100,000 tax problem from 2022, that's a go hurry up and go get this solar business going.
That's exactly right. Now, it doesn't work that way for everyone. Sometimes
Yeah.
people can buy a dollar of tax credit for less than 50 cents. Sometimes people buy a dollar of tax credit for closer to 80 or 90 cents.
Hmm.
That
Interesting.
has to do with what tax bracket they're in when they're acquiring these extra credits because you're buying the credits at a discount based on their brackets. And as they get closer and closer to the zero bracket, we can buy the tax credit at lesser and lesser of a discount.
Makes sense. Makes sense. Yeah, interesting. Talk about long-term gains. A lot of my listeners have long-term capital gains, from a sale of an asset. Is there a way to reduce or eliminate long-term capital gains?
Yes. And that's really the fun part that we had with the third layer of the planning with the HVAC owner. We do this all the time. You don't have to have high ordinary income to save taxes. If you have this huge long-term capital gain, it can also help you save taxes. And there's a few ways to do it. I love this question, Todd. Thanks for asking it. One would be pre-sale focus, meaning that you're going to sell an asset. It's going to have a substantial capital gain. Fortunately, most of it's long term, not short term, because short term capital gain is ordinary income tax. Long term capital gain, you get needs a lot lower federal tax treatment. State's going to take what the state's going to take. But if we plan prior to the sale, we can either shift that asset or even a portion of the asset. You don't have to take all of it. You can take whatever percentage ownership you have or whatever percentage ownership you want to carve out, shift that ownership into another structure prior to the sale. That way, you have not taken constructive receipt of the income or assignment of income at the sale. So now when the sale occurs, there's no immediate tax implication to the structure that powers the sale, right? So now you have all that money. So say you had a $10 million sale and you're in California where you're paying 3.7 million of that to the Fed and the state, right? So
Yeah.
now instead of having 6.3 million left after this, you worked so hard for however many years to get this asset to where it is, and now your 10 million is 6.3. Instead, you have say much closer to 10 million in the structure to reinvest.
Hmm.
And now your tax bill can be deferred and you're only paying taxes as you access those funds outside of the structure. Or there's even ways in those structures to eliminate tax. That's a much more sophisticated planning. But there is a way to shift dollars into entities and technically over time eliminate the tax instead of just defer it. Or let's just say you didn't get this memo until after you sold the business. You're like, man, why didn't I talk to you like
It's going
six
to be a
months
huge
ago when I
bill.
was selling?
Yeah.
We say, don't worry. Um, how much of income did you have on the sale? And they said, let's just say it's $4 million, just a average sale, not a huge sale, $4 million of income. Okay, well, how would you like to buy $4 million of loss? And they say, well, that sounds good, but how much is it going to cost me? Well,
Yeah.
what if you can buy $4 million of loss for $400,000
That'd be
plus
great.
some structuring fees? Okay, well, let me do the calculation. Depending on where they are, right? $4 million in California is 37% of that.
Right.
Well, I'll buy the $4 million of loss for 400,000. That's way lower than my tax bill.
Yeah.
So then we have this loss to offset the gain, and we can apply it to it because of the rules of the game. We are deferring it, but we have strategies to continue to defer and even get a step up in basis at some point when because we're not going to live forever. So if we can keep deferring the structure that offset the loss until we die or we assign the interest to someone that we love that will die a lot earlier than we will, but there's no skin off their back, then we get the step up in basis and we just kind of put the tax ticket to the side, never had to deal with it. So these are some unique ways. I mean, they're progressive, but they're following the code and they have been challenged and defended well. So
Yeah, that's great. Yeah, because of course that's the key to all of this too, is you don't want to do something that you think you're going to save a bunch of money in taxes, and then you find out that you get an audit or the IRS sends you one of those nasty grams and says, "Hey, you owe us whatever it is, three
that's
hundred
right.
thousand dollars, right? And you got to pay it now. And you got, by the way, you got penalties on that too, and late fees. And so it's not only $300,000, but you've got all these penalties, and now you owe us $340,000. Like, oh crap. So yeah, I think you definitely want to do it right.
Absolutely. And here's the thing, when we go through this planning and we start making um, recommendations or saying these are things that would apply to you, we definitively get into the risk as well. Just like we're not doing investment management, but a good investment manager is going to say, well, here's your risk in
Here's
this
some risk.
investment. Same thing for tax planning. Hey, we are following the code. There have been considerable, maybe court precedent in these. There's been literal cases where, the plaintiff, the IRS has lost, but we can say, but this is where it could go wrong.
Yeah.
So just because in the past the IRS lost doesn't mean the IRS will lose again if
Sure.
you don't follow the rules.
Sure.
And if for some reason you do lose, let's look at worst case scenario.
Hmm.
So we always want people to understand what is worst case scenario, and that way they can make a more comfortable decision, knowing that just like anything, I could buy this asset and I might lose money. Well, I can use this tax planning strategy, and I might lose money, but only if my risk of my get I get audited, which is usually less than like 5%, and I actually did something wrong. I didn't follow all the rules. So there's a pretty low percentage, but again, we always want to paint that picture.
Yeah, for sure. Sure. Um, yeah, the audit's the scary part. I actually got audited. Um, boy, a long time ago when I was a teacher, and it was funny because I found out I actually overpaid the government. So I sent them a letter saying I overpaid them and they can write me a check. And they responded back that said they don't write they don't write checks. uh, that I'd have to apply whatever. I'd have to redo my tax, however it was. But that was the only time I was audited. It was I was just making W-2 income, nothing else. Um, I when I'm looking at you know your bio and all that kind of stuff, I see here that you say there's a way for to get the IRS to fund a portion of your client's retirement 100% tax free. That sounds too good to be true. Tell me about that. What is that about?
No, I love, that is the statement that people start scratching their heads and like,
Yeah,
wait a second, how does that work?
I want that.
And yeah, exactly. And it's just resourceful planning. Okay, let's take one element of what we kind of discussed before. Let's just say we have a client that all they do is they say, I like the easiest thing that we can do. And we say, okay, let's donate assets. So you get a deduction that saves you more in tax than it costs you to buy the deduction, right? So for example, they buy a $1 deduction for say 20 cents. And they're in a high tax bracket in Florida. I mean, excuse me, in California. So that $1 deduction is going to save them 50 cents. It only cost them 20 cents to buy a 50-cent tax savings. Okay, that's a fantastic return. You could argue it's a little over 100%, right? You put 20 cents in, you get 50 cents back. That's 100%, 150, 15% return or whatever.
Great investment.
But that's actually not a good argument. It's an infinite return. Why? Because if they didn't buy that asset and donate it, they wouldn't have had the 20 cents to invest.
Hmm.
But we're taking 20 cents of their tax liability and turning it into 50 cents of tax savings. So technically that's an infinite return. But here's where I'm going with your question. We take 20 cents of what you would have paid in tax. We buy an asset with it. We donate that asset. It saves them more than 20 cents. Let's call it 50 cents in this scenario. The best case scenario, California. It's not as good in Florida or Washington. So now you got 30 cents that you received kind of out of thin air, right? You really created 30 cents of profit from 20 cents of tax liability. So that 30 cents is like, so they've already given you 30 cents of tax-free money based on tax savings. Now, how do you build a retirement around that? Well, I told you I was in insurance for in my first few years of after I left the fitness and wellness world.
Yeah. Okay.
Well, as you know, if you structure your insurance policy right, and a lot of really wealthy people do this, they overfund it up to the 7-year corridor, and they have as little insurance as they can and as much cash flow, cash accumulation as they can above it. So now they're going to get 5, 6, 7% compound returns on that, plus the benefit of insurance, and then they can borrow against that insurance policy without taxes. So they literally
That's
took
so
that
cool.
30 cents that they saved from their tax liability, put it into an insurance policy, maxed out the cash value. Now it grows at 5, 6, 7%, depending on your insurance structure, and you never pay taxes again. So that's how
That's
we
awesome.
can say technically you get a tax-free retirement from the government.
That's cool. That's cool. I love that. That's a great strategy. Didn't even think about that. Um, I love strategies that help you save on taxes. There's a lot of people that get really nervous, I think, about that, and that they just don't want to do anything wrong, so they just do it the way they're told to do it. What would you say to those people that they just want to do things 100% black and white? I make this money like that. Why would you say like hey, maybe you should think a different way?
Wow, that's a really loaded question. I would say, I would say to that person, the conversation would be very specific, very similar to probably the conversation they have with their investment advisor if they have one, right? Because that same person sounds to me like, well, I want bonds
Yeah.
and annuities
Right.
and blue chip stock, but maybe not too many of them. Like they want the most conservative portfolio possible, which is going to give them 4 to 6%, which might not be okay. Well, what if you took a percentage of that portfolio and you shot for a little bit higher returns.
Yep.
But you're willing to. Same thing with taxes. We say, well, look at your tax liability. Maybe we can reduce your taxes by 70%. But why don't we just do this one layer and reduce them by 20%? Maybe that's a little bit less. Uh, I guess you have a little bit more comfort
Yep.
in knowing, especially when you know that, hey, well, what if you lose on this 20% tax? You do get audited, and you know, something wasn't done correctly, which is where I'm guiding them. Like, obviously, I don't want to put them anything that's done incorrectly. That's my job, just like an investment advisor. I don't want to put you in some rogue fund that's gonna, things
Yeah.
happen.
Yeah.
But at the end of the day, we say, even if you lost on this 20% and you did this 10 years in a row and you lost, 1 year out of the 10, look how much further ahead you're going to be.
Yep.
Or even if you just lost in general, you're not that much further behind, but you took a shot. So that's really kind of where I would go with this is,
Yeah. Love that. Love
yeah.
that. Um, Mark, let's shift gears a little bit. What's a mistake that either you've made or a mistake that you see your clients make? But what's a mistake that you can talk to our listeners about, and how have you learned from it?
The biggest mistake is, as particularly in risk decisions that involve risk, is to overanalyze so much so that you get paralyzed.
Yeah.
So there's an element of risk that you do need to obviously count your cost. What are but sometimes people get frozen. So I think that is an area that people really need to pay attention to. Don't get frozen because of overanalysis. And also, too, just because you make a wrong decision doesn't mean that you should be scared to not make another wrong decision. Learn from it and make another decision. Just get up. Every time you fall down, get up. Because if you don't, you're not going to win.
Yeah, absolutely. You got to take some risks to win. I love that. Yeah, analysis paralysis, right? You can't overthink it, overanalyze, and then never make that decision. You're just not going to go where you need to go. Um, Mark, what's a favorite book you can recommend to our listeners?
That one's real easy. It's the Bible.
Great answer. Love that.
Yeah.
You got a certain
Learn about your creator.
You got a favorite book in the Bible?
I love Ecclesiastes. There's a lot of wisdom there, right?
Yeah.
Solomon was given a lot of wisdom by our creator, and he writes all about it in Proverbs and Ecclesiastes. So I really, really like that book.
My favorite is uh, Proverbs. So right
Proverbs,
there with you.
absolutely. So much wisdom.
Yeah.
So much
Yeah.
wisdom in that book.
What are your three pillars of wealth creation?
Pillar one is never stop educating yourself because the environment is always changing. And if you're not keeping up with the changing environment, then you're not only not going to produce wealth, you might lose wealth. So that will be pillar number one. Pillar number two is to protect your principal as you acquire it. So once you acquire earnings, make sure you keep those earnings. So that would be, for every dollar of earning, how much are you going to double down and take that dollar of earning and put it into risk?
Hmm.
Maybe you're only taking for every dollar of earning, you're taking 20 cents of that and putting into a higher risk profile, not the whole dollar. So that will be number two. And then pillar of wealth number three would be look for areas to increase wealth that you might not realize are there. One being tax efficiency.
Yeah.
Right? Wait a minute. I can pay 50% less tax, or even if you pay 20% less tax, it's a discount on a bill that you have to pay. So think about how much further you can get ahead. If every year you're saving 50% on taxes, and maybe there's a cost to save 50%. So at the end of the day, you're netting 25%. Well, how much less aggressive do you have to be in the market if every year you're keeping 25% more of your money because you're sending less to the IRS?
Very true. And how much more can you compound your wealth, right? If you're saving 25% of your wealth, you get to reinvest that 25% of your wealth, and that compounds very quickly. If especially we start to add that up year after year after year, I mean that can be a very significant amount. And it doesn't matter where you're at
100%.
in your financial journey either. 25% is 25%. It's a big amount no matter what.
That's absolutely right. That's absolutely right.
Love it. Mark, anything that we didn't cover that you want to make sure our listeners hear from you?
Well, we covered a lot. I really appreciate all the fantastic questions. They're so fun to answer. I would just say, if anybody wants to kind of learn a little bit more, I could tell them
Yeah,
where to reach out if they go to our website at taxwisepartners.com. Learn a little bit more about us. And we have you can actually click and find a little complimentary, our schedule, and you can hop on for a 15, 20-minute complimentary conversation. And literally all we need is 15 or 20 minutes to determine if there's an opportunity for sizable tax reduction.
that's great.
So no cost and not a lot of time just to see if there's some opportunity there.
That kind of sounds like a no-brainer to me, actually. So we'll put that
I,
link on the show notes, listeners. You can just go right to the show notes and click on it. Otherwise, you can go to TaxWise Partners. It was taxwisepartners.com. Is that correct?
that's correct.
Yeah.
Taxwisepartners.com. I'll just
TaxWise.
give one caveat would be for ordinary income, we really need to start seeing 250 or more for the things that we do to make real sense. So
That makes sense.
although you pay a lot of tax when you start making 150, 200, 200 plus, but it's one of those weird windows. It's like when you're a teenager, you're not quite adult yet, but you're definitely not a kid. That weird, once you push into the 300,000 plus of AGI, then you can, because now you're pushing into the higher tax brackets
Sure.
and we have to buy those discounts. So it's hard to buy a discount when your bracket's only 22%, but when your bracket's 32, 35, 37, it's a lot easier to do it. So just want people to keep that in mind. Not that we don't want to help people that make less than $250,000 or 300 some thousand a year. We do. It's just there's not as much opportunity. But when they start climbing that realm, or when they have that capital gain, we don't care how much ordinary income they have. If they have generally 400,000 or more of income from that appreciated asset capital gain, then that's really the time for us to start talking as well.
That
Because
makes
everything
sense.
has a cost. Yeah, tax savings has a cost, just like business. You have to spend money to save money. Like in business, you have to spend money to make money. In taxes, you have to spend money to save money. We
Yep.
always want to make sure that you're spending less money than you're saving.
Yeah. Love it. Love it. Well, again, Mark, really appreciate you. Appreciate the time. This has been great. And man, you have a fantastic rest of the day.
You as well, Todd. Thank you so much. I really appreciate the time.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.